Well, welcome guys to class. We're going to start with chapter 1, Managerial Accounting. And no, wrong class. Financial accounting? I don't think so. Here, managerial accounting. I don't know what I'm doing wrong here. Here? Oh my goodness, bless you. My husband would say to me, slow down. Okay. So we are starting with managerial accounting. Now, you all are familiar with financial accounting. I will be honest with you. I think that's way harder than this class. Some people will say to me they think managerial accounting is much harder. I don't see it that way because you learned all those new concepts, a whole new language. This is a little more nitpicky and detailed, but you've already been through the hard stuff, in my opinion. Managerial accounting is for inside users. So what we're going to talk about are the various costs that make up managerial accounting. Today's a real overview of managerial accounting. We know managerial accounting is concerned with providing information to managers within an entity so they can make decisions. Cost classifications are really huge in managerial accounting. We're going to talk about assigning costs to what we call cost objects. And then we're going to talk about why we do accounting for costs in manufacturing companies. We'll be preparing financial statements, understanding how based on changes in activity, how costs change, and how we use this information in order to make decisions. So we're going to start by talking about cost classifications, direct costs and indirect costs. What are direct costs? Those are going to, hi there, just come on in and take a seat. And don't let me forget to ask your name because I need to have a seating chart. Oh, how are you? I know all you guys from financial. Yeah. Direct costs are costs that can be easily and conveniently traced to a unit of product or other cost object. Direct costs are direct materials and direct labor. Now, one of the easiest things I think of is an automobile assembly line, okay? An automobile has, excuse my ignorance, I'm assuming that's steel. Sometimes you think it's just damn plastic, but I think it's steel, right? You can determine fairly easily the specific materials, direct materials that go into that automobile. And the direct labor would be those individuals on the assembly line. Those are literally direct costs that go into making that product. Can anyone think of some other ideas of direct materials and direct labor? mean, I kind of did an easy one. Yes. And guys, you can just answer.
Like a Heinz ketchup factory.
Yeah. So like, give me an example. What would be direct materials? The plastic?
Yeah, plastic, the making, like all the ingredients.
Yeah, would go into the direct materials. That makes sense? Is there a Heinz factory around here? I don't know if there's a Heinz. What's in Northfield? Jenny O or Lionel Lakes? I think you're right. Excuse me one sec. I'm trying to log into my system here. Can't connect to this network. Okay. And the guys, is our username the path
Yeah, it's your star ID. Like
at minstate.edu and then okay. Don't tell me I can't connect. Okay, so direct materials and direct labor would make up our direct costs, okay? Now, assigning costs to cost objects. Indirect costs are costs that cannot be easily traced to a unit of product. Examples are what we call manufacturing overhead. Let's say we have a factory, and this factory produces various products. And in the factory, we have a cafeteria. We can't really depict how that cafeteria directly relates to a bottle of ketchup, can we? But it is still a cost of making these products because we need a cafeteria for the workers when they take a break. Or what about the insurance for the building? That is a cost of making products, but it's not specifically assigned to a specific automobile. All of these indirect costs that are still important and can make up, create a lot of cost or expense, still need to be assigned somewhere, and we assign them to manufacturing overhead. Indirect costs can include rent, can include utilities, and general office expenses. Oh, come on. Now, we're going to look at the three basic manufacturing cost categories: direct materials, direct labor, and manufacturing overhead. Direct materials are those raw materials that become the basis or the foundation of the product. And you can easily trace those materials to the product, such as the glass for the windshield, or the radio for the car, or the leather for the seats. Okay? So a radio installed in an automobile can easily be traced to, it's a clear product directly associated with the car. Direct labor costs are those direct labor that is easily retraced to a unit of a product. The biggest one here are wages paid to the automobile assembly workers. Easy. But guys, this is where the numbers get big. Manufacturing overhead. This is what includes all manufacturing costs except direct materials and direct labor. These costs are huge, but you can't really trace them to a specific product. That's why we lump them in this bucket called manufacturing overhead. They include indirect materials that cannot easily be or conveniently traced to specific units of products, or indirect labor costs that can't be easily or conveniently traced to specific units of product. Greasing the machines, repair on the machines, the supervisor, the security guards, and the list goes on and on, the janitorial. Now, examples of manufacturing overhead. Depreciation on the equipment, property taxes, utility costs, water, electric, gas, insurance premiums. Indirect costs that are associated with operating the factory are included in manufacturing overhead. Guys, the administrative costs, the president, that's a separate deal. We're dealing with making products, and costs associated with making those products are going to include everything in the factory, not necessarily an administrative. Okay. So we've talked about direct costs. We've talked about indirect costs. Those indirect costs make up manufacturing overhead. Now, to just make it a little more confusing, there are prime costs and there are conversion costs. And guys, the best way to learn this is just to write them down. So when you have a quiz, you can go back and say, I know we talked about this, go find it, because you can use your notes. Thank God I don't have to memorize everything for taxes. I'd be in trouble. I have books that I can go to. I personally view accounting the same way. You know, there's so much to learn. I'm not asking you to memorize these things to forget them. I'm asking you to find them, okay? Because I'd rather you spend your energy not stressing out that you got to memorize something. That's what we do in first grade. Not now. There are prime costs. Prime costs are direct material and direct labor. So if you get a question, what are prime costs? You know it, direct material, but you can go find it. Direct material, direct labor. What are conversion costs? Direct labor and manufacturing overhead. Okay. Now, there are other costs in a business that may not be linked with direct labor, direct materials, and manufacturing overhead. We call these non-manufacturing costs. They're still important, but they're in a separate category. Selling costs are costs necessary to secure the order and deliver the product. Selling costs can be direct or indirect, but they're non-manufacturing costs, and those are put on the income statement in the period they were incurred. Administrative costs are the executive, organizational, clerical costs They can be direct or indirect costs, but they're not manufacturing costs. They're not part of making the product. So these are placed on the income statement in the period they're incurred, not when the product is sold. Okay? Manufacturing costs are separated, and we write those off or expense them to cost of goods sold in the period those products are sold. Non-manufacturing costs are period costs, which mean they are incurred and put on the income statement when they happen, because they're not related to the product. Am I going fast enough, too fast, slow, too slow? Will you let me know? So, classifying manufacturing costs. The PC Works assembles custom computers from components supplied by various manufacturers. The company's small and its assembly shop and retail sales store are housed in a single facility in a Redmond, Washington industrial park. Listed on the next slide are some of the costs that the company incurs. For each cost, indicate whether it would be most likely be classified as direct materials, direct labor, manufacturing overhead, selling, or an administrative cost. Okay? So, the cost of a hard drive installed in a computer. What do you think that would be? Direct materials. Totally right. What about the cost of advertising in the Puget Sound computer user newspaper? Selling? Selling costs. They're trying to advertise, promote. The wages of employees who assemble the computers from components. Direct labor? Excellent. Sales commissions paid to the company's salespeople. Selling. They're still costs, but they're not manufacturing costs. The salary of the assembly shop's supervisor. Indirect manufacturing overhead. The salary of the company's accountant. Administrative. Depreciation on equipment used to test assembled computers before release to customers. Overhead, manufacturing overhead. Rent on the facility in the industrial park. They're saying here it's a combination, because maybe there's a portion of in the industrial park, some selling and administrative. It's kind of a trick question there. I'll try not to give you trick questions, okay? It's a combination of both manufacturing overhead and could possibly be administrative and selling. The rent would most likely be prorated on the basis of the amount of space occupied by the different departments. Okay? Now, let's look at how we utilize these classifications to prepare financial statements. Are they a product cost, part of direct labor, direct materials, and manufacturing overhead? Are they a period cost, which means they're put into the income statement when they incur selling and administrative expenses? Product costs include all the costs that are involved in acquiring and making the product. Product costs get attached to a unit of product as it's purchased or manufactured, and they stay attached to each unit of product as long as it remains in inventory awaiting for sale. Remember, the big key with financial accounting is you match revenues with the costs that were incurred to help produce those revenues. Remember that? When we're dealing with products, we don't take the cost to those products until the goods are sold. And then we match them under cost of goods sold. That's what we mean when we're talking about product costs versus period costs. Period costs are going to happen no matter what products are being sold, like administrative and selling. Product costs are only expensed on the income statement when they're sold. Okay? Okay. For manufacturing companies, product costs include raw materials, the metal, the glass, the radios just in their boxes, help me, the wires, I'll stop now, but you understand the point. The goods that help go into making the finished automobile. Raw materials include any materials that go into the final product. Work in process consists of the units of product that are only partially complete and will require further work before they're ready for sale to the customer. Work in process are the automobiles on the assembly line. Finished goods consist of completed units of product that have not been sold to customers. So raw materials are just the raw products. It gets transferred into something called work in process as the materials are requisitioned from the different departments or the raw supplies to go into the automobiles. And then they stay as work in process until the car is complete and ready to be sold. Then it goes into a category called finished goods. When direct materials are used in production, their costs are transferred from raw materials to work in process. Direct labor and manufacturing overhead costs are also added to work in process to convert direct materials into finished goods. Once units of product are completed, then their costs get transferred from work in process to finished goods. Once a manufacturer sells its finished goods, it then gets transferred from finished goods to cost of goods sold. And we know that cost of goods sold is on the income statement, right? So here you see product costs, the direct materials, direct labor, and manufacturing overhead are part of the balance sheet. It's an asset, a current asset under inventory. And they stay on the balance sheet until the product is sold. Once the product is sold, it gets off of the income statement, the balance sheet, and goes on the income statement into cost of goods sold. Period costs include all selling and administrative costs. They automatically go straight to the income statement. Okay. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? Manufacturing equipment depreciation, property taxes on corporate headquarters, direct material cost, electrical cost to light the production facility, or sales commissions. Period costs, meaning they don't go into the product. They're a period cost. They're expensed on the income statement when they happen. The reason property taxes on corporate headquarters, it's not the factory. If it said property taxes on the factory, that wouldn't be a period cost. That would be a manufacturing cost or a product cost. Sales commissions, we know, are period costs. Selling and admin, always period costs. Okay? Suppose that you've been given a summer job as an intern at Isaac Air Cams, the company that manufactures sophisticated spy cameras for remote controlled military reconnaissance aircraft. The company, which is privately owned, has approached a bank for a loan to help finance its growth. The bank requires financial statements before approving the loan. Classify each cost listed on the next slides as either a product cost or a period cost for the purpose of preparing a financial statement to the bank. Product costs, remember, go with the product once they're sold. Period costs go straight to the income statement. Okay. So depreciation on salesperson's cars. Are they a product cost or a period cost? What are period costs? They're period because it's a salesperson. Sales and administrative expenses go straight to the income statement. It's not part of producing the product. Okay. Rent on equipment used in the factory. Product. Lubricants used for machine maintenance. Product. Salary of personnel who work in the finished goods warehouse. What? Product. Oh, I was wrong. Salary of personnel who work in the finished goods warehouse. The goods are already done, so the product is done. I'm sorry, guys. So period cost, sorry. Soap and paper towels used by factory workers at the end of a shift. Product. Factory supervisor salaries. Heat, water, and power consumed in the factory. Are you getting the gist? Materials used for boxing products for shipment overseas. Period. It's part of selling and admin, right? Advertising costs. Period. Workers' compensation insurance for factory employees. Product. Depreciation on chairs and tables in the factory lunchroom. The wages of the receptionist in the administrative offices, period. Cost of leasing the corporate jet used by the company's executives, period. The cost of renting rooms at a Florida resort for the annual sales conference, period. The cost of packaging the company's product costs. Now, understand cost classifications used to predict cost behavior. We're going to look at variable cost, fixed cost, and something we're going to call mixed costs. When we talk about cost behavior, we're talking about how a cost will react to changes in levels of activity. The common classifications are variable cost, fixed cost, and mixed cost. A cost that varies in total in direct proportion to changes in the level of activity is a variable cost. Variable cost per unit is constant. Yeah, I'll give you a minute there. Okay. Now, what drives costs? What can drive cost? A measure of what causes the incurrence of a variable cost. It can be based on units produced. It can be based on miles driven, or machine hours, or labor hours. But usually there is a commonality that we can use to help drive the cost. So if we are manufacturing ketchup bottles, we might use machine hours to really determine how we drive our costs. If we're working possibly on an assembly line that's heavy labor, we would use labor hours to show what's driving our costs. Does that make sense? If we're dealing with delivering products, or if we're using some type of formula due to travel, we would use miles. So the activity-based is what drives our costs. The most common are these four: units produced, miles driven, machine hours, or labor hours. A fixed cost remains constant, regardless of changes in the level of activity. If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes in activity. I have a CPA office in Apple Valley. I pay rent of $2,600 a month. I pay rent if I see any clients or if I see no clients. That is a fixed cost. I also have a receptionist who pretty much works 40 hours a week. She works 40 hours a week if we make no money that month, or if we make a bunch of money that month. That's a fixed cost. Make sense? Types of fixed costs can be committed long-term, cannot be significantly reduced in the short term, like rent. Discretionary fixed costs may be altered in the short term by current managerial decisions. Now, here is when we talk about the relevant range. There is a total cost. The straight line closely approximates a curvilinear variable cost line within its relevant range, meaning all costs at some level can become variable. So in other words, if I am in an office where we're doing 1,500 tax returns a year, my fixed cost of rent stays the same. But because I'm saying I'm doing 1,500 returns a year. But what if all of a sudden I start doing 7,000 returns a year? Do you understand how you need to within a relevant range? Once I jack it up to 7,000 a year, I'm going to have to get a bigger place. So fixed costs remain constant when within a relevant range of what you're doing. Does that make sense? Yes, if I then jump up to 15,000, my little puny office isn't going to handle it within a relevant range. The relevant range of activity pertains to fixed costs as well as variable costs. For example, assume office space is available at a rental rate of 30,000 per year in increments of 1,000 square feet. Fixed costs would increase in a step fashion at a rate of 30,000 for each additional 1,000 square feet that are needed. So if you need more square feet, then they're going to increase. But you can handle so much square footage if you're in a certain relevant range. The relevant range of activity for a fixed cost is the range of activity over which the graph of the cost is flat. So if all you need is 1,000 square feet, then here's your fixed cost. But if you need to jump to 2,000 square feet, again, here's your fixed cost within that relevant range. Or 3,000 square feet, here's your fixed cost within that relevant range. So variable costs in total variable cost increase and decrease in proportion to changes in the activity level. Per unit, though, variable costs remain constant. Okay? Fixed costs in total, it's not affected by changes in the activity within that relevant range. But per unit, fixed costs per unit decreases as the activity level rises and increases as the activity level falls. So if I have 1,000 square feet and I see 500 clients, if I associate some of those fixed costs per client, if I have 500 clients versus 1,000 clients, do you see that that fixed cost associated per client is going to decrease as I have more clients? Because I have more clients to spread it over with. Okay? Which of the following costs would be variable with respect to the number of ice cream cones sold at a Baskin-Robbins? There may be more than one correct answer. What would be variable, guys? Cost of the ice cream? And D, the cost of the ice cream and the cost of napkins. More clients, more napkins, right? The cost of lighting the store and the wages, aren't those fixed? Okay. Listed on the next slide are costs of providing an airline service. Classify the cost as either variable or fixed, direct or indirect. Consider the cost object to be the flight. Flight attendants and pilots are paid based on hours of flight time. So we have advertising, beverages, regional VP salary, depreciation on ground equipment, fuel used by planes, flight attendant wages, pilot wages, aircraft maintenance. Now we are, the cost object is going to be the flight, okay? So advertising is a fixed cost and it's an indirect cost. What do you think of beverages served on a plane? Variable and direct, right? What about the regional VP salary? Fixed and indirect. Depreciation on ground equipment is fixed and indirect. It's going to happen no matter what. Fuel used, variable and direct. Variable based on how many miles, right? Flight attendant wages, variable and direct. Again, they get paid per hour they're in the air. Is this a trip going over to Tokyo or is this a trip going to Sioux Falls? Pilot's wages, variable and direct. What about the aircraft maintenance manager's salary? Fixed and indirect, is it? Okay. A mixed cost contains both variable and fixed elements. Consider the example of utility costs. So there's a fixed monthly charge and there's a variable cost per kilowatt hour. Okay. So there's a certain monthly amount you're going to pay no matter what, and then they charge you per kilowatt hour. The total mixed cost line can be expressed as an equation. Y equals the total mixed cost. A is the fixed portion. B is the variable portion, with X being the level of activity. So we can determine how much is the fixed portion and how much is the variable portion. Y equals A fixed plus BX variable times activity. So if your fixed monthly utility charge is 40 and your variable cost is 3 cents per kilowatt hour, and your monthly activity level is 2,000 kilowatt hours, what is the amount of your utility bill? A is the fixed plus 3 cents times 2,000. So 40 plus $60 gives you the 100. So, Northeast Hospital's radiology department is considering replacing an old inefficient X-ray machine with the state-of-the-art digital X-ray machine. The machine would provide higher quality X-rays in less time and at a lower cost per X-ray. It would also require less power and would use a color laser printer to produce easily readable X-ray images. Instead of investing the funds in the new X-ray machine, the laboratory department is lobbying the hospital's management to buy a new DNA analyzer. For each of the items, indicate by placing an X in the appropriate column whether it should be considered a differential cost. You know what? We haven't gone through those yet, so let's not worry about that one yet. Okay. Differential sunk or opportunity. Let's wait a minute on that. Okay. This is what I want to do. Differential. We'll do this, then we'll go back to that. How about that? The costs of the salaries of the head of the radiology department and laboratory department and the rent on the space occupied by radiology are neither differential costs or opportunity costs or sunk costs. These costs do not differ between alternatives and therefore are irrelevant in the decision, but are not sunk costs because they occur in the future. Let me just see. I don't think this was in here in the right spot. I am sorry. So we haven't really talked about differential sunk and opportunity yet. Let's go through here and we'll go back. Okay. Every decision has at least two ways they can go. Alternatives, options. The goal of making decisions is to identify those costs that can be relevant or irrelevant to the decision. To make decisions, we need to have a grasp on various types of costs that happen. Sorry, that problem should have been after this. We need to know the various types of costs: opportunity costs, differential costs, and sunk costs. A differential cost is the difference in cost between two alternatives. A difference in revenue between two alternatives is called the differential revenue. They're relevant to making any decisions. Differential costs can either be fixed or variable. Opportunity costs is the potential benefit that is given up when one alternative is selected over another. These costs are not usually found in accounting records, but need to be accounted for. Okay? So when someone is here going to school to get a new pathway or career, instead of working, you're choosing to be here. The opportunity cost is what is not happening because you're here today. Okay? While we can't always put a figure to it, it's real, and it is something that's being given up in order for you to be here. What's the opportunity cost you incur by attending class? Well, you can't work. You might need daycare for your kids, right? Sunk costs have already been incurred and can't be changed now or in the future. These are irrelevant costs and should be ignored when making decisions because they're going to happen anyway. They happened. It already occurred. You can't change it. In business decision making, a sunk cost is a cost that's already been incurred and can't be recovered. Sunk costs are sometimes contrasted with prospective costs, which are future costs that may be incurred or changed if an action is taken. Suppose you're trying to decide whether to drive or take a train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in making this decision? Yeah. In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? Do you think the train ticket's relevant? I'd say it's relevant. Because if the train ticket, you have to take into account the ease of not having to pay attention, of driving, the parking. But if the train ticket's just exorbitant, wouldn't that modify your decision? Possibly, or take it into account. Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. Is the annual cost of licensing your car relevant in this decision? No. Who cares? It's a cost you've already incurred. Suppose that your car could be sold now for $5,000. Is this a sunk cost? Hadn't happened. Sunk costs have already incurred. Okay. Now, preparing an income statement for a merchandising company using traditional and contribution formats. The traditional format shows sales minus cost of goods sold minus selling and administrative expenses. That's what we're familiar with in financial accounting. In managerial accounting for management, a contribution format statement can be more beneficial. This is where you show sales minus the variable expenses minus the fixed expenses, because basically our sales minus our variable expenses show what we have available to put towards our fixed expenses. Okay, so different in volume allows different options here. The contribution statement is an internal planning and decision-making tool. We're going to talk about all these. We're going to have these different chapters that we'll talk about down the road. So, excuse me. To handle this, Marwick's piano purchases pianos from a large manufacturer for an average cost of $2,450 per unit. And then it sells them to retail customers for about $3,100 each. The company's selling and administrative costs for a typical month are shown here. So we've got our advertising, our salaries. So a portion are fixed and a portion are variable, aren't they? Delivery of pianos, utilities, depreciation of sales facilities, executive salaries, insurance, clerical, and depreciation. Some have a mixed component. You see that? During August, Marwick's Pianos sold and delivered 40 pianos. Prepare a traditional format income statement for August. Then we're going to do a contribution format statement for August. Okay? Got it? So a traditional statement would show the sales of 40 pianos at $3,125 per piano. Then we would show our cost of goods 40 pianos at an average of $24.50 per piano. Then we have our gross margin. We take our selling and administrative expenses. A couple of them, the sales commission, we had to add 8% times 40 pianos, you know. And then we had delivery of 40 pianos at $30. And then some clerical. This is our traditional statement. Now, if we look and do a contribution statement, you see we show the sales minus the variable expenses. Now, the variable expenses are the cost of the piano, the sales commission, the delivery, and that clerical portion. Then we have our contribution margin of 15,000 minus our fixed expenses gives us our operating income. Okay? We take all the variable costs and put them up here before we hit our contribution margin. This then is what we have to pay for our fixed expenses. Excuse me, the 15,000 is what we have to pay for our fixed expenses. Now, oops, sorry guys. Fixed costs remain constant in total, but can vary on a per unit basis. Inversely with changes in the activity level, but as the activity level increases, the fixed costs will decrease on a per unit basis. Showing fixed costs on a per unit basis might mislead management into thinking the fixed costs behave in some way as the variable costs, but they really don't. The fixed costs are going to be there no matter what. Management might be misled into thinking that the per unit fixed cost would be the same regardless of how many pianos are sold. For this reason, fixed costs generally are shown only in totals on a contribution format income statement, meaning that in the contribution statement, the variable costs are shown up top to lead to the contribution margin. Okay? So what I'd like to do is go through some homework. But I'm going to run to the restroom real quick. So one thing I want to show you here. Sometimes these can be good. Let me see if oh, that's not what I want. That's a little nerdy. I'm not going to worry about that. Okay. Let me get the homework going for you. Because how many of you guys brought your computers to class? Awesome. Open them up. Get into McGraw-Hill. We're going to work on them together, okay? Let's start with this espresso store, okay? Let me, can you guys see that okay, even though I make it smaller? Or should I make it bigger? Can you see that better? Okay, I'm just gonna do this. We'll do this one and then I'll take a break in a minute. Okay. So in this one, Espresso Express operates a number of espresso coffee stands in busy suburban malls. The fixed weekly expense of a coffee stand is $1,200, and the variable cost per cup of coffee served is 22 cents. Fill in the following table with your estimates of the company's total cost and average cost per cup of coffee at the indicated levels of activity. Does the average cup of coffee served increase, decrease, or remain the same as the number of cups of coffee served in a week increases? So here you see for requirement 1, we've got fixed costs, we've got variable costs, total costs, and average cup of coffee served. What are our fixed costs? $1,200, right? Right? So fixed costs are going to be $1,200 across, no matter how many cups of coffee are served in the relevant range. Yes.
How do we connect to the internet here? Like, it's wanting a username and password. Would you just put in
Username, I think for you is your star ID at minstate.edu or something like that.
Okay.
I think that's, I just heard someone say, mine doesn't work. Mine is just the username, but I remembered in my first class, you had to put in your username at minstate.edu. I'm sorry, go.minstate.edu.
And then the password would just be your star ID.
Yes. So does that make sense that your fixed costs are going to be the same no matter what? Right? Variable cost, 22 cents times 2,000 cups of coffee is what? $4.40. 22 cents at 2,100 cups of coffee, what? $4.62. At 22 cups, 2,200 cups, $4.84. What is the average cost per cup of coffee at 2,000 cups? 1640 divided by 2,000 is 82 cents. For 2,100 cups, 79.1 cent. And for 2,200 cups. Now, guys, say you want to check your work. You can go and check your work. Make sure you got it right. Okay. Does this help to do some of these together? You guys tell me when you're done, okay? I don't want to rush you. When I kind of can see everyone's done typing. Anyone need more time? Can I move on? Okay. Now, does the average cost per cup of coffee served increase, decrease, or remain the same as the number of cups of coffee served in a week increases? What happened, guys? As we shoved more cups of coffee, what did the average cup of coffee do? It was decreasing, wasn't it? And why was that, guys? Because our fixed expenses were going to be fixed no matter if we served 1,000 cups or 2,000 cups, right? So the more cups of coffee we had, we could spread that fixed cost. Make sense? You guys good with that? Okay. I want you to start here by preparing a traditional income statement. And then we're going to prepare a contribution, but I've got to run to the restroom real quick. Is that okay? Now, I'm sorry with me walking. It might take me a little bit to walk and get back. I'm doing way better than I was. Talk about frustrated. For about 8 days, I couldn't even put weight on it. So I'm coming a long way, but I'm slow. I'll be right back, guys. Okay, so for the traditional, we're going to show our revenues or sales of 600,000. Whoops. Cost of goods sold is going to be 160. Our gross margin It's 140, excuse me, 440. Then we've got our fixed selling. Oops. How many got that? Make sense? Yes, no? Okay, so moving on to do the contribution format, we would show the sales of the same amount, 600. But then we would have our cost of goods sold. To be 160. Selling. To be 80. Admin. $40. This will be our contribution margin. Is the difference. 600 minus 280 would be 320. Yep. And then our fixed selling expenses. An administrative of 30. $250. Yeah. Does it make sense, guys? Clicking? Can I move on? Yes, no? Yes. Okay. So this next one, Cuban's company's relevant range of production is between 18,000 to 22,000 units. When it produces and sells 20,000 units, its average cost per unit are as follows. What we have to do for the first one is assume the cost object is units of production. What is the total direct manufacturing cost incurred to make 20,000 units? And what is the total indirect manufacturing cost incurred to make 20,000 units? So direct manufacturing, we see direct materials, direct labor, right? Direct materials. So the first thing it says is direct materials per unit is how much? $7. The direct labor per unit, 4. And what is the direct manufacturing cost per unit? Oh, it tells us, it gives us 11. Okay. So the number of units produced and sold are what? 20,000. So our direct manufacturing cost would be 220,000, right? The the variable manufacturing overhead per unit, $150. Yeah, $150. The fixed manufacturing overhead per unit, $5. The number of units produced and sold, 20,000. So our total indirect manufacturing cost here would be 130. Okay. Now let's look here. Assume the cost object is the manufacturing department and that its total output is 20,000 units. How much total manufacturing cost is directly traceable to the manufacturing department? How much total manufacturing cost is an indirect cost that cannot easily be traced to the manufacturing department? Again, our direct materials per unit was 7. The labor was 4. The variable manufacturing overhead per unit, 150. The fixed manufacturing overhead per unit was 5. Same figures as last time. So our total cost per unit is $17.50. 20,000 units. So we have 350,000 of direct costs, 0 in indirect costs. Okay? Does it make sense? Next, assume the cost object is the company's various sales representatives. Furthermore, assume that the company spent 50,000 of its total fixed selling expense on advertising, and the remainder of the total fixed selling expense comprised the fixed portion of the company's sales representative's compensation. When the company sells 20,000 units, what is the total direct selling expense that can be readily traced to individual sales representatives? When the company sells 20,000 units, what's the total indirect selling expense? How much is the sales commission per unit? $1. Number of units sold, 20,000. So 20,000 is sales commissions. Fixed portion of sales representatives' compensation, 20,000. So total direct selling expense is 40. What's the indirect selling expense? The advertising expenditures can't be traced to specific sales representatives, can they? And that advertising expense is how much? $50,000. Got it? Can I move on?
Yes.
Okay. Kublin's company's relevant range of production is 18 to 22,000 units when it produces and sells 40,000. Am I? No, I've got to be on. What am I doing? Oh, 4, here it is. So you got to scroll down on that one. For financial accounting purposes, what is the total amount of product costs incurred to make 20,000 units? Total product cost. How did you come up? You're right, 350,000. We take our direct materials, direct labor, variable manufacturing overhead times 20,000 units, right? And then we take our average fixed manufacturing overhead, so 350,000. And the total amount of period cost incurred, 150. And 150 would be the result of variable selling and admin times 20,000 units, $1.50 times 20,000, and then your average fixed selling and administrative of $6. So 150. Total amount of product costs, direct materials, direct labor, variable factory overhead is 1,250 times 22,000. It says, what is the total amount of product costs incurred to make 22,000 units? And then we've got fixed manufacturing overhead at 100,000. So this is 375. You've got direct materials of 7, direct labor of 4, variable manufacturing overhead of $1.50. That 1,250 times 22,000 units gives you 275,000 plus the 100,000 of fixed costs. Okay, gives you 375,000. Okay. Now, total amount of period costs. Sales commissions are $1. The variable administrative 50 cents. So $1.50 for variable selling and admin times 18,000 units gives us 27,000. Along with our fixed selling and admin of 120, this figure should be 147. If you guys have questions with this, put a note in the discussion for chapter 1, and I'll show how I'm getting it. Okay? Got it? Then for number 5, if 18,000 units are produced and sold, what is the variable cost per unit produced and sold? Direct materials are how much? 7. Direct labor, let me see if I can get an Excel in here. So direct materials is how much, guys? 7. Okay. Direct labor is how much? Variable manufacturing overhead, 150. Sales commissions, a buck. And then variable administrative, 50 cents. So we should have a variable cost per unit, 14 bucks. Okay. And it doesn't matter if it's 22,000 units or 18,000 units, the variable cost is going to be 14 bucks, right? Now, number 2, again, same. Number 3 says if 18,000 units are produced and sold, what is the total amount of variable costs related to the units produced and sold? So we've got 14 number of units, 18,000 units. This would be 252,000. 14 units times 22,000 units. This would be 308,000. Right? Average fixed manufacturing cost per unit produced. We would have our fixed manufacturing of 100 plus our number of units produced of 18,000. That would give us 556 per unit. But if we increase to 22,000 units, it would be 455. Then last, our total fixed manufacturing overhead, no matter what, it's still 100,000 units. Okay. Now, because we're running out of time, I'm going to pull up the rest of the questions so you can take a picture of them. Oops. Here's number 7. And what will even be more helpful is for you to see the reasoning down here, okay? Then requirement 2. And then the reasoning. Now, for number 8, a traditional, the contribution format, contribution margin per unit. Now, the one thing I have not been able to go over is your Excel. I think what I'm going to do is in the chapter 1 discussion, help you get started on that. I'll probably put a video in there so you can see how I'm working it. Okay, but guys, remember the Excel is as much every week except the last week we have an Excel assignment. And so you'll want to pull up the Excel and it just asks you to be familiar, change some numbers on it, but I'll get you started. Okay, last, and then I'll be done. You have homework, or excuse me, the quiz. Now it is a pool. So I'm just going to show you, well, 10 out of 42 questions. So you 25% chance you're going to see these questions again. Lucky you. Okay. So you're going to have just multiple choice. Here are the examples. So chances are you're going to get 25% of these you're going to see. DeLongis is a merchandising company. What is the contribution margin? You guys know how to figure that out. Sales minus variable expenses, right? Right? Next. What's the gross margin? Remember what gross margin is? Sales minus cost of goods sold. Next, Fiori's relevant range is between 3,000 and 7,000 units. When it produces and sells 5, its average costs are as follows. The incremental manufacturing cost that the company will incur if it increases products from 5,000 to 5,001 is closest to, how do you figure it out? Next. What is the sunk cost? Remember, sunk cost is something that has already incurred. Okay. If 5,000 units are produced, the total amount of fixed manufacturing overhead incurred is closest to what? Fixed manufacturing per unit times the number of units. Amount of product costs incurred, product costs, direct material, direct labor, factory overhead. Okay, then we've got period costs. We know period costs are selling and admin. Then we've got product costs, direct costs, and indirect manufacturing costs. Do you think you guys can figure this out? Okay, please, if you have questions, you're going to